So let's look at the securities available for sale, our third category. These are equities that, or debt and security equities that you are holding on to. You don't have an immediate plan to turn around and sell them immediately, nor do you necessarily plan on holding them to maturity. You're just holding them. You're holding them until you decide that you want to sell them. The primary difference here, you're still dealing with the fair value adjustment account, but the primary difference here is you are not going directly to net income with any unrealized holding gains or losses. Rather, you are going to use the other comprehensive income section of your income statement. All right, and this is a section that you should have covered in Intermediate 1 a bit more, the other comprehensive income area. So looking at these, if you had that same $3,500 loss, unrealized holding gain or loss from that previous example, you would show it here, as I mentioned earlier, in the other comprehensive income section, which isn't a net income, which isn't a primary income statement item. So here's the negative $3,500 for the other for that loss that you have not actually realized yet. So when they do actually go into some place, right, where does this other comprehensive income section go? If you go back a second, you can see other comprehensive income all goes to, these items all get accumulated into this other comprehensive income category. So when it becomes accumulated other comprehensive income, when you accumulate it all together, they wind up becoming part of shareholders' equity. So within shareholders' equity, you've got common stock, paid in capital in excess of par, and now you've got these unrealized holding gains and losses, as well as those other categories in this accumulated other comprehensive income section, retained earnings, and then you have total shareholders' equity. So it hasn't actually touched your net income. If it touched your net income, then it would be in retained earnings, but rather it's in this other newer account, accumulated other comprehensive income. Okay. All right, now looking at the same facts we had before for the trading securities item, you had 1,000 shares of stock, $42, and so on. You had basically $3,500 worth of unrealized holding gains and holding losses in this case. But instead of treating them as trading securities, we are going to treat them as available for sale securities. So what we're going to do in this case is we are going to debit to net unrealized holding gains and losses other comprehensive income, and we're going to credit to the fair value adjustment $3,500. Really, the only difference here is where this loss is going to. Instead of it hitting income directly, it's going to be going to other comprehensive income section, which may not seem like much, but it is a pretty significant difference. So the same scenario as before. What if we sell it for $65,000 in cash? Well, we record our cash piece first. Sorry if you're hearing my kid in the background. $65,000 in cash. You're reducing your investments in the trading security. Oh, sorry, trading securities. This is funny because it should be the securities available for sale. All right, so it shouldn't say trading securities there. It should be securities available for sale. That's a mistake in the slide. Good thing I don't write the slides, I guess. And your credit is to the gain on sale of investment. So nothing in here has changed for the actual sale part of it. As far as the second piece, the fair value adjustment, that goes away, right? The same as it did before. And the other difference is that you are crediting net unrealized holding gains or losses, other comprehensive income. All right, so journal entries are virtually identical. The only difference here is going to be the other comprehensive income versus the income statement. All right, so what happens if you decide you're going to transfer between the different categories? Because maybe you are holding something as a security available for sale, but then you decide you're going to transfer it to the trading securities, or if you're going to take it from trading securities and put it into one of the other categories. All right, so this is a good graphic that kind of shows you what happens, and it makes sense if you think about them. I'm just going to look at the first couple. But what if you went from either securities available for sale or held to maturity to the trading category? Well, if you do that, then you've got to make sure you include the current net income, any of the total unrealized gain or loss, as if it all occurred in the current period. So you don't go back and change anything, but basically you're saying if you had stock, or maybe you had a bond that you were holding as, that was held to maturity, and it was in that category, and you were holding it at that value. Well, if you are going to move it into the trading securities area, then you're going to make sure that you recognize all of the gain or the loss that had been unrealized up to this point and put it into net income directly. All right, what if you had a trading security and you're moving it into either of the other, held to maturity or securities available for sale? Well, first you're going to catch up any unrealized gains or losses that occurred in the current period, and then you're going to, any unrealized it's just going to go over to the new categories as the current fair value. All right, so it kind of makes sense. It's just an idea. More than anything, I want you to realize that you can transfer between the categories. Just because originally something was a trading security doesn't mean it has to stay there. Just because something was originally held to maturity doesn't mean it has to stay there. They can move around and you can recategorize them. It's all about your intent. Okay, what if we have an impairment of our investments? Since this entire chapter is about investments, we're going to talk about what happens in various scenarios. Well, what if you have an impairment? An impairment doesn't just mean a regular loss of some kind. An impairment means a significant loss that is most likely going to be some sort of permanent loss. All right, and they refer to it as OTT, which is other than temporary, which it's the first time I've ever heard that acronym, but I don't trade in securities often, so maybe I'm just out of the loop. But anyway, so if you have these held to maturity and available for sale investments and you have a huge loss, you recognize that impairment loss in your earnings. All right, so you take the loss. If you know that there's going to be some sort of massive loss here because there's an impairment in the value of the assets, then you are going to record the loss on your income statement. However, what if you record the loss and instead over time it comes back up, the value of the asset? Well, you can only do this for a loss. You basically are setting a new value on your books, a new historical value for those assets, and you can't write them back up to where they were before. Instead, that impairment loss brings the value down basically permanently, and from there, from that lower point, you would be recognizing any sort of unrealized holding gains or losses. You would treat them as almost the new value. Let's say you had $100 share of stock and something horrible happened and now the stock's worth $5. All right, and that is going to be, maybe that is an impairment, right? So you've got a $95 loss on that share of stock. You're going to recognize that immediately, and that new $5 is going to be your baseline that you work from. All right, let's move on to our next category. That investor has significant influence. So we've already covered all of these where we do not have significant influence. But now we're going to be looking at we do have significant influence over the operating and financial policies of the investee, the company whose equity we have bought. All right. So we're looking at these, and this is usually we have a significant influence if we have 20 to 50% equity ownership. All right. These are guidelines, and the reporting method that we're using is called the equity method. All right. It basically means we are large enough of an owner that we exert significant influence on the company. Okay, so here's the question: what is significant influence? Now we're saying that the guideline is the 20 to 50% piece of it. However, if we do own 20% of the stock and we would normally have to do this equity method of treatment, we can avoid the equity method of treatment if certain, I don't know how to say, categories maybe, or certain criteria are met. That's probably the best way to say it. What if the investee, the company, challenges our ability to exercise significant influence through litigation or other methods? Basically, investee says you do not have the right or to exercise significant influence, therefore you do not use the equity method. Or what if we, the company buying the stock, say we do not want to exercise significant influence on your company. All right, so there's a couple of things you can do to avoid that 20 to 50% category, forcing you into the equity method. But for the most part, the general guideline is 20 to 50% put you in that, 20 to 49.9% put you into that equity method. All right. This equity method is not quite consolidation, but it does attempt to show the strong ties between the two companies. This is a good summary slide of how the equity method works, in the sense of the investor, the company buying the stock, recognizes investment income equal to its percentage share of the net income earned by the investee. All right. rather than the portion of that net income received as cash dividends. Now, that may not make too much sense to you just yet, but you will see it when we actually use some numbers to calculate those amounts. All right, initially we record the investment at cost when we buy the stock, and we actually increase the value of the stock by our percentage of net income, and we decrease our investment by the dividends paid out. It's almost as if we're treating it as it's a subsidiary of ourselves. Now, I probably shouldn't say it that way because it's not truly a subsidiary, but we are trying to show that how the company does, the investee, is reflected directly in our investors' reporting of ownership. All right, before I get into numbers, I think I'm going to save this and move on to a new screencast.